Hello everybody. So today I would like to talk to you about a trade idea that I've just put on. This is a Q4 trade. It's a long idea and it's in a stock called Alibaba, which, as some of you will probably already know, is actually a Chinese company, but it's dual listed in Hong Kong and in the USA. So it has a US ticker. It's an ADR, an American Depository Receipt. And the ticker is BABA. So I'm going to talk to you briefly about my bull thesis for Alibaba Group and the idea behind the trade and the trade structure and why I think this is a good risk-reward situation. So firstly, what does Alibaba do? Well, it's one of the leading e-commerce giants in China. Over the last few years, the company has transformed from traditional e-commerce to a conglomerate that's got businesses ranging from logistics and food delivery to cloud computing. They've got three main businesses: Alibaba.com, Taobao and Tmall. So the company as a whole actually accounts for more than 50% of all online retail sales in China, which of course is one of the world's fastest growing e-commerce markets. Taobao is one of Alibaba Group's most profitable marketplaces. That generates more than 80% of the total company's sales, down to soaring demand for particularly high-quality imported brands into China. So the company is well positioned in the not-so-new retail space. The company also brings together digital payments, e-commerce, food delivery, and other parts of the business into essentially one big ecosystem. The cloud business, which was launched in 2009, is now one of the biggest in China. And the cloud computing aspect of the business has become one of the fastest growing businesses and is now the second largest revenue contribution for Alibaba. Here's a 12-month chart. And I think what is a feature that comes out from this chart in particular is that you've got a couple of bottoms there back at the end of 2023 coming into 2024, and then again at a similar kind of level in April, May time of this year. And that's when the stock actually got down to the IPO price from 2014. And as you can see there, it's hit that level a couple of times and then bounced up, particularly after the April occasion when it hit that level. So the background to the trade idea: why would I want to be long Alibaba? So I want to talk generally, first of all, about the kind of Chinese situation. The Chinese economy, and by extension the Chinese stock market, have essentially been in a world of pain since 2020. Why is that? Well, it's down to an enormous debt pile, which is related to the housing and construction market. And it's also down to a very slow post-COVID economic recovery. The economic problems actually began before COVID with an overdeveloped real estate market that essentially went from boom to bust. When the country's real estate bubble finally collapsed, the top developer, Evergrande, collapsed under an enormous mountain of debt. And as the economy has slowed, of course, the debt to GDP ratio has gone through the roof, such that it got to almost 300% last year. As already mentioned, China also experienced one of the slowest post-pandemic recoveries, partly because of the extended lockdown policy that was amongst the most draconian of all responses globally. The Chinese stock market has mimicked the floundering economy and has drastically underperformed global markets since 2020. However, in my opinion, there are some signs that suggest that the worst could be over for Chinese equities. So let's go through those points. Number one, I think it's fair to say that almost everybody actually hates Chinese stocks. Expectations for the economy and stocks have basically hit rock bottom. I think there could be some signs out there also of the Chinese consumer possibly being on the mend. An example would be just in the last couple of weeks. Tesla China has insured 15,500 Tesla units. That's just in the last couple of weeks, which makes it, first of all, the best week all quarter. And it's also after several months where essentially Tesla sales in China dried up. So they've experienced this large uptick in sales in the last few weeks. Also, there's an ETF whose ticker is KWEB. This is a $5 billion China internet ETF that contains stocks like Tencent, Alibaba itself, PDD, JD.com. And in recent weeks, you've seen quite a lot of large volume buyers of call options on KWEB. Alibaba itself had their quarterly results, their earnings report on August the 15th, where effectively the results were slightly mixed. So they had a small beat on earnings, but a small miss on revenues. Interestingly, the stock price is essentially flat since those results. So I'm wondering, is the worst in terms of what people were expecting and factoring in behind us? As mentioned earlier, the stock has retraced a couple of times back to its 2014 IPO price, and it's bounced strongly off that most recently back in April. In terms of the valuation for the company, this is by no means a reason in itself for the stock price to rally, but just to give you the context, the stock has got a ton of cash. It's got a massive cash pile, and it's got an almost double-digit free cash flow yield, which is kind of unheard of these days. It trades at less than 1.5 times 2024 revenues, and there are impressive growth prospects for all of the individual business segments. So the way that I look at the stock is it's essentially a call option on a bottoming or a recovery of the Chinese stock market and economy. Over the last month, and since the last quarterly earnings report, consensus analyst annual and quarterly earnings estimates have been going up. In other words, the stock is gaining positive earnings momentum. Plus, they also have an active and significant share buyback program. Now, these are catalysts that normally will help, particularly in the case of positive earnings momentum. That normally helps the share price. And lastly, although, of course, I nor ITPM recommend copy trading, I did think it was interesting that David Tepper, who founded Appaloosa Management, in the fund's latest 13F SEC filing, he's disclosed that his largest position is a $750 million holding in Alibaba. Now, he's famous for buying financials like Bank of America in 2009 at distress levels, from which he made a killing. So as I say, copy trading is not something that we endorse at ITPM. However, it's an interesting observation to make. Now, the trade structure. How have I structured this trade? So I'm long what's known as a calendar spread, a calendar call spread. So I'm long November contracts and short September contracts. More specifically, I'm long slightly out of the money November calls. So I'm talking about the 85 strikes. And I'm short the same strike calls for September, but on a 2-to-1 ratio. In other words, for every 2 November out of the money calls that I'm long, I'm short 1 September out of the money call with the same strike price. As I say, $85. Now, if the stock price does not shoot up quickly above the strike price, then I should get a decent credit on the short side for September. But even if it does, because I'm long 2 contracts for every one that I'm short, I should make decent profits from that structure, even if the stock price shoots up quickly. As a senior trading mentor at ITPM, this is exactly the type of option structure that we teach our students to look for. If you're interested in being mentored as a trader or require further information, please go to the ITPM website, itpm.com. That's it for this time. Happy trading, everybody.